All right, today we're doing a deep dive into Renaissance United's latest quarterly report. We're going to go way beyond the headlines and really try to understand what these numbers mean if you're looking at this from an investor's point of view.
Okay, so let's just jump right in. The first number that leaps off the page in this report is pretty incredible. The company's losses have been cut by more than 95%. Now, on the surface, that sounds like amazing news, right? But, the headline almost never tells the whole story. So, is it actually time to pop the champagne, or is there more to it? Let's find out.
To answer that, we have to start with that headline number. And the big story, coming right out of the income statement, is just how dramatic this turnaround looks.
And there it is, a 95.1% reduction in the loss after tax for the quarter. I mean, compared to where they were this time last year, that is a huge swing in the right direction. A number like that, it definitely makes you sit up and pay attention.
And this chart just lays it all out visually. I mean, just look at the difference here. A year ago, in this same quarter, the company lost over 2.2 million Singapore dollars. This year, that loss is down to just 111,000. It's a total night and day difference.
So the big question is, how on earth did they do that? Well, and this is the important part, it wasn't just about slashing expenses. This turnaround was actually fueled by some serious growth. The company's revenue for the quarter shot up by 26.4%. Having more money coming in the door is a pretty great way to shrink a loss.
Okay, so a big jump in revenue is fantastic news. But to really get a handle on the business, we need to know, where did that growth actually come from? Let's dig in. So this chart gives us the lay of the land for the company's business over the last 9 months. And you can see Renaissance United is basically two companies in one. The lion's share, about 73% of their money, comes from gas distribution. The other 27% or so comes from their electronics and trading business. So clearly, that gas business is the main engine here.
But here's where the story gets really interesting. Their huge gas business grew by a solid but not spectacular 2.3%. But look at the electronics segment. It just exploded, growing by almost 145%. So, the much smaller part of the company was actually the superstar that drove this quarter's incredible revenue growth. All right, so rocketing revenue, shrinking losses. Sounds great, right? But that's all from the income statement, which is really just a snapshot of performance over a few months. Now we need to switch gears and look at the balance sheet. This is like the company's long-term financial health check, and this is where we find the but in the story. And this brings us to a really critical question for any investor. Is one great quarter really enough? Or do we need to see proof of real underlying financial stability? Making money is one thing, but being able to actually pay your bills, that's a whole other ballgame. To get what's going on here, we have to talk about something called net current liabilities. It sounds complicated, but it's not. All it means is that the bills a company has to pay in the next year are bigger than the cash it has on hand, plus anything it can sell for cash quickly. It's kind of like looking at your personal bank account and realizing your upcoming credit card bills are more than the money you have to pay them.
And this slide just lays it out in black and white for Renaissance United. On the one hand, they've got about $31.7 million in current assets. But on the other hand, they've got $44.5 million in current liabilities. That's the debt that's due soon. You don't need to be a math whiz to see there's a pretty big gap there.
And that gap works out to $12.8 million. That's their net current liability. And that, you have to say, is a pretty big financial risk the company has to manage. It's the one major cloud hanging over that otherwise fantastic performance we saw earlier.
So what we have is the story of great performance sitting right next to a significant financial risk, which leads to the obvious question, what's the plan? Let's look at the company's own outlook and see how they plan to deal with this.
Now, despite that liability number we just saw, the board of directors is on the record saying they are confident. They believe the company is what's called a going concern, which is just finance speak for we can stay in business and pay our bills. So, why are they so sure? Let's get into their strategy.
The company's game plan really breaks down into 3 parts. First, they want to grow that core gas business. Second, they're going to leverage that super stable and fast-growing electronics business. And third, they're working on some new ventures to create totally new streams of income.
So let's look at the main business first, the gas distribution, which is run by their subsidiary HZLH. They've got a few things they're working on here. They have a new pricing policy to make sure their revenue keeps up with their costs. They've locked in a new partner to import LNG, that's liquefied natural gas, which gives them supply security. They're also expanding into new industrial areas, and hey, they might even get a little help if China cuts interest rates.
Okay, now what about that electronics business, ESA, the one that grew like crazy? Well, this isn't some flash-in-the-pan startup. This is a stable company that's been around for 30 years. And what they do, it's called burn-in testing for semiconductors, is absolutely vital for hot sectors like AI and automation. And critically, this part of the business has almost no debt and is very healthy financially. It's a real gem.
And finally, there are the new ventures. Their arm in the US has a new 8-year marketing deal that's already bringing in cash. They also own some land out in Washington state they're looking to develop. On top of that, a new property in Malaysia is set to start bringing in rent next year. These are all smaller pieces of the puzzle, but they all add up to more diverse revenue and better cash flow.
Okay, so we've looked at the good performance, we've looked at the risk, and we've looked at the plan. So what's the big takeaway for an investor trying to make sense of all this?
So here it is, the bottom line. The good news is fantastic. Losses have been slashed, revenue is up, and it's all thanks to an incredible performance from the electronics division. But, and it's a big but, that $12.8 million net current liability is a serious risk you just can't ignore. Now, the plan to fix it seems pretty solid. They're focusing on their core business, using the strength of their electronics arm, and building new income streams. It's really a classic tale of high risk versus potential reward. And that really leaves us with the million-dollar question, doesn't it? We've seen one amazing quarter, but we also see a pretty big financial hurdle to overcome. So will the company's strategy be enough to close that gap and turn this impressive short-term win into real, sustainable, long-term financial health? Well, that's exactly what investors are going to be watching.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.